Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes.
Good afternoon, everyone. Welcome to my Tuesday session on real estate and taxes. Today, we're going to be talking about 7 strategies that can help you minimize your taxes in 2025. Today's agenda will include talking about students, families, couples, as well as people with disabilities, followed by a conclusion. So first strategy includes payroll source deductions. So whenever you're working with an employer, you pretty much get gross pay minus your CPP, EI, and taxes, and the net amount comes to your account. My suggestion is to apply for T1213 form, which will allow you to basically tell the employer to not deduct too much taxes. What do I mean by it? So basically, when this person is filing taxes, if they are getting a heavy refund at the end of the year, they can simply inform the employer to deduct lower taxes. And with this form, they can tell them exactly lump sum or periodic payment of RRSP, alimony, maintenance payments, charitable donations, or investment, leaving you with more money in your pocket on a monthly basis. So now that we have talked about the first strategy, let's move on to the second strategy, which involves spousal loans. So basically, if you are a high income earner and you invest in a stock market or real estate, any capital gains that you will make will get taxed at your marginal tax rate, which was to be high, and you pay low, you basically end up with nothing at the end of the day. What I suggest is, if let's assume you have a lower income spouse, you can basically loan the money to her and or him and basically have them invest in the market. What would that do? That would basically, as part of the loan, they would basically invest in the market. Any income that they generate will be added to their lower income spousal income and not be taxed at the highest marginal tax rate. But do keep in mind that if you're loaning money to your spouse, you need to charge them interest, and this interest must come to your bank account before January 30th of the following year. And keep in mind, this loan must have prescribed rate of interest based on CRA's guideline for 2025. Now let's look at the third strategy. The third strategy includes buying a home. So let's assume you purchased a home and you withdrew from your RRSP towards buying a home. This is called home buyer withdrawals, right? When you withdraw money from your RRSP as part of the home buyer plan, you now have to repay into your RRSP. This installment that you have to repay is basically paid within 15 years after you have purchased the home. For one of the year, if you don't make the repayment, you will be penalized by taxes. But my suggestion is, if let's assume you had a job loss, or you were on 6 months sabbatical, or you're in the lowest tax bracket, then home buyer plan, if you miss the payment, that payment gets added to your income and you'll be taxed. But because you didn't have any income, you're still in the lowest tax bracket. So even if you miss the payment, it might still work in your favor. Do remember, the last day to pay for a home buyer's plan for this year was March 3rd, 2025. So make sure to make that contribution before the deadline. So the fourth category is for people who are nearing retirement. What happens during retirement is CRA will pay you old age security, CPP pension plan, and your RRSP will also be converted into a RRIF, which gets paid to you on an annual basis and gets added to your income. The problem with this is, once all of them get added together, they get taxed based on however your marginal tax rate is. How do I avoid, or how do I reduce this? Well, what I suggest is splitting income with your spouse. What this will do is, if let's assume your pension income, OAS, and RRSP withdrawals are becoming $100,000 a year, now if you split it, it becomes $50,000 each on your husband and wife, and overall the tax liability on first $50,000 is lower than one person paying taxes on $100,000. So my strategy is split income with your spouse in order to reduce your taxes. So strategy number 5 involves people with disabilities. So let's assume you have someone who you're taking care of because they're disabled and you have the disability tax credit. The Canadian government allows you to open a plan called RDSP. It means Registered Disability Savings Plan. The benefit about opening this plan is it basically gives you a grant money of up to $70,000 in Canada Disability Savings Grant and up to $20,000 of Canada Disability Savings Bond from the Government of Canada. So this is a great tool for someone who is suffering and taking care of their family members, and it can definitely help you lower the financial burden of taking care of them. So I would highly recommend looking into this plan and opening it up sooner rather than later to take advantage of the government grants. The sixth strategy is, do you have non-deductible debt? Most of the time during the holiday season, we had to max our credit cards, and because of this maxing out the credit card, you have to pay interest expenses. This personal interest is actually not deductible if the money was not being used for business purposes. So what do I suggest? I suggest instead of taking and maxing out loans on your personal card, do it on a business card, and technically business cards interest can be written off against normal courses of income or even for investment. Last but not the least, pay your child some sort of expenses for your child care. What do I mean by that? For example, if you have an adult child in your home and an underage child who needs childcare services, you can pay your adult child to take care of your little one, and actually you can write it off. You can technically claim it as a write-off. Any income that you pay to the adult child will actually be written off, whereas the child will then report it in their income. Once they report it, even then they don't pay much taxes. Why? Because on the first $15,000 worth of income, there's not much taxes in Canada. The maximum that can be claimed would be $8,000 per child under 7, $5,000 per child between ages 7 to 16, and $11,000 for children eligible for disability tax credit. Make sure you follow these guidelines before paying your child, because otherwise you won't be able to take advantage of the tax write-offs. Well, now, in conclusion, there are many more tax deductions available, whether it be donations, whether it be deducting investment expenses, carrying charges, or whether it be looking at different strategies surrounding life insurance policies. All of these do help you in taxes, and if you're still confused, you can reach out to us and we'll be more than happy to plan for your taxes for this year. Make sure you keep the deadline of April 30th, 2025 in mind, because that's the last day to file taxes for individuals who are not self-employed. Self-employed people get an extension till June 15th, but if you have an amount owing, you still need to pay it by April 30th. Thank you and have a good day.